Well, welcome to the class. If I can count correctly, this should be my sixth lecture to you. And today we'll be finishing one section or one part of the four-part course. And the first part was about the definitions, if you can go back and look at your notes, and the concepts, the developing the language of the subject of contracts and agreements. And I'm going to use the word contracts and agreements interchangeably, which I've said it many times. And then followed by the second part or second section will be about different types of agreements. That's where we will start today. And the third part will be more like legislative issues that are related to policy, where we will circle the globe. In the third part particularly, where I'll take you to Norway, to Indonesia, to Colombia. We talk with the United States and to China. And we're going to show you some of the important aspects of their agreements, and just to give you a global perspective. And as we go, you'll appreciate what I'm saying. And it's legislative. In other words, these are the regulations in different countries that affect where a company decides to go. It's not just the oil that they have in the country, the regulations that are important too to the companies, how limiting or how restricting are the regulations, and are these to the benefit or detriment, and how much is the benefit, how much is the detriment of these regulations. All these are going to be covered in part 3. I'm not sure if I'll start with part 3 today, because I plan to cover part 1 and part 2 of the 4 kinds of agreements that we have. And they are, and okay, before I get carried away, and the third section was that legislative issues. And finally, we'll end toward the back end, or toward the end of this semester. The course is negotiations. So the reason I gave you this rundown on what to cover, what is left to cover, so you know exactly where we end the course. We have covered a good deal, and today only one definition is left, which I'll cover very shortly. Having said that, today I'm making an exception with respect to the past. In the past, I call out the roster, that is the students that are registered in this class, only once at the beginning of the semester. But this time, I plan to do this twice. Once I called out your name at the beginning of the semester, and now I'm going to do that again because some students have dropped, others have added. The more than I normally come across, that adding and dropping of courses this time. There has been quite a few, adding, some subtracting, taking out courses. So I thought it'd be nice for you to have another chance to listen. If your name is on the roster, that is the official list of names that have come to me that you're taking the class. And when you give the exam and you're graded, these are the names that I'll be sent by the registrar on which I have to post your grade. If for some reason, I doubt very much, for some remote reason, your name is not called out today, just call up the registrar's office, get in touch with them, not me, of course. They are the ones who will take care of it. I doubt if that will be necessary. In the past, whenever there was a student dropping the course or adding the course, I would, or all the instructors would, get some kind of a notice from the registrar, Mr. X is dropping or Mr. X is taking up the course, adding. But now I don't get any direct communication. I wish they did tell us, the instructors, who's adding or who's subtracting, but since I do not, or instructors do not receive that directly from the registrar's office, so that is the reason I'm going to call out your names. Okay, now that explains why I'm going to do this today. As of today, the names that are, by the way, there are 3 sections to this course on petroleum concessions and agreements. And they are PGE 383, PG 360, 363, PG 383, 363, and EER 396. Okay. So let me first call out the names of students who have registered in PGE 383. Okay. And there are, let's see, there are 10 students that I see on the list. And I'm going to call out the names, and I ask you to forgive me if I mispronounce your name, because some of these names are foreign to me, like my name is foreign to some of you folks. So I'll try my very best to be as close as possible to what you like to be called by your pronunciation. Maybe I'll make a little error here or there, but I think you'll forgive me for that. Let's start with the first name out of the total of 10 in PG 383. Muhammad Akmal, that's the first name, Muhammad Akmal. Then it's Uthman Al-Homidi, Al-Homidi. Then we have Abdul Hadi Al-Bukhari, Abdul Hadi Al-Bukhari, followed by Abdul Hamid Al-Susi. Al-Susi is the last name. And then we have Mr. Ali Agbali, E as in Edward, G Great, H Henry, B Ball, A Apple, L London, I India, Agbali. And then is Odai, O-D-A-I, and the last name is Elias, E-L-Y-A-S. And there's Wendy Liu, L-I-U, Liu. And we have a Sarah Myers. Sarah Myers with M as in Mary, E, Y is in yellow, E, Edward, and R, Robert. Adian Mirsha. Okay, Adian Mirsha is registered here. And the last on this PG 383 roster is number 10 is Mr. Muhammad Said or Suaid, S-U-A-I-D. So if the names I've called out and your name is the one that I've called out, rest comfortably. These are the names I have. And if you give the exam and you do well, you will be graded according to this roster, and it should show up in your transcripts. The next roster is PG 363. And it's a petroleum leasing regulations and practices. That's the same as international petroleum concession agreements. I caution you, do not be worried if you have your PG 363. Do not be concerned that your title of your course says petroleum leasing regulations and practices. Both the international petroleum concession agreements and your petroleum leasing regulations are the same. The students attend the same course. At the undergraduate level, we call it petroleum leasing regulations and practices. And at the graduate level, it's called international petroleum concessions and agreements. The contents are the same, the lecture is the same, everybody listens to the same subject. And the names are only of two persons. And the first one is Mr. Andrew Jeffries, excuse me, followed by Nathan McDermott. That's the two we have here in this class, in this section is Andrew Jeffries and Nathan McDermott. The last section I have, the number 3 section, is EER 396. And there are only 2 students. Wow, this is I'll have to first look at it, pronounce it in my own way, and then call it out loudly. This is Pata Raporn Kongdi. Pata Raporn Kongdi is the last name. K as in Karachi, okay, as in kite. H Henry, O Oliver, and Nancy, G Good, D David, I India. Kongdi. I hope I got it right. And Mr. William Lovell. Lovell is the last name. That's 2. I see the total number of students in all three sections add up to no more than 14. That's the only 14, okay? And if some of you might be wondering, what is this EER business? Let me clarify that for you. And just in case, let me clarify what is EER here. It stands for Energy and Earth Resources. I used to be the director many, many years back. It was physically residing on the 4th floor of the PGE department. And at that time, it had a name called EMR, Energy and Mineral Resources. The name was subsequently changed to EER. It's the same course, no, same what do you call it? Nothing has changed. It's the same. EER, EMR are the same. In fact, at the time it was called EMR, Energy and Mineral Resources. Both are daughters. And took that, they have a degree in EMR, now called EER, because I thought it was a very good program. And so I asked them or suggested that they should take it as a degree program, as a master's level. And they took it, and thank God, that was many, many years back. And they're doing quite well. They got a good job, and they are quite happy with it. Having said that, oh, well, I didn't explain what's the difference ER. Just by way of explanation, as you know, as graduate students, there are some courses, you know, the requirement of courses that you have to take to graduate, certain number of credit hours. And but out of the total number of credit hours that you're required to take before you graduate as master students, there are some that are to be taken, a few of them, and have to be taken outside the department. That means they will not have a PGE listed in front of them. They can be taken outside. It could be taken in mechanical engineering, they could be taken in geology or any other subject, not in the department. So that is when I said to myself, let me call this same course as EER or EMR. I did, that's what I started. And so that it is now counted as an outside the department course requirement. It fulfills the course requirement of outside the department course requirement. It's an elective. And if you graduate advisor, Dr. Safanuri, knows all about it. And make sure what I'm saying, he has cleared it with you. I'm 100% correct, or maybe 99.9999. But he's the one who's going to sign off on your certificate, that degree certificate, that you have met the requirement to be awarded the MS degree. Okay. So do touch base with him, and he will, and he'll know. You know, he and I, we go back a long time. He was about this little boy when I met him. Like at least 40 years back. There is no professor in our department that was here when I came here. Not one, okay? So I go back since 1972 when I came here as a master's student. So you can add up the number of years. In May, I will be here for whatever number, 51 years. In and out, mostly in, less out of the university. So I go back a long time with the university. Now, what next? The first section of this course, as I repeat, which I just said, was to talk about definition and concepts and to develop the language of agreements. And we went through maybe 24 of those words. Now you can go through what is carried interest and so on. Farm in and farm out, norm price, all that stuff, okay? I deliberately left out one word from that section, one definitely. And that word is royalty. I didn't want to cover it last time. I could have done it and finished section. No, I did not. Because I feel that when I talked about royalty, this I see it as a connection between section 1 and section 2. We moved in section 2 in 5 minutes. So the question is, what is royalty? Very simple. Like everything else I've taught is simple. Anybody in 5th grade can understand that. I take pride in the fact that I make life simple. I don't know why people make things simple, things complex. I do the other way around. It's not difficult. It's also nothing have I said in this or finance class that it's a Thursday class that anybody with basic common sense cannot follow that. So that's what it. So part 2 of this program, and I'm going to repeat from what I just said, it's going to talk about different types of agreements. That's where we are now. If you want to, and I encourage you to write, I can write it on the board, but you can write it yourself. I'll speak slowly, you have enough time to write. We're going to talk about 4 types of agreements in the world that exist that I know of. We'll first cover the first agreement we'll talk about today, starting today, is a concession. Concession is one kind of an agreement. C-O-N-C-E-S-S-I-O-N. That's just the name of an agreement. This is the oldest kind of an agreement that has existed in the oil business. After we looked at what is a concession, for you to understand it, I will show you something, this cash flow from A all the way to a K. Or rather, I prefer you only, K would be fine, K, A to K. You'll be working with a simple arithmetic. It's an Excel program. This will come to you as a part of my lecture as attachment 1 that you see at the top. And the word is concession, you can see yourself yellow and underlined. I may give you 20, 25 minutes, depending on how things are going, to go through this cash flow from A, go this way, A, all the way to the end. Work out the top 2 or 3 lines and see how they're derived. If you have any difficulty, the simple way to look at it would be there over here at the bottom. You see there's a little formula. I can't look at it backward. You can look it up there. It should not be difficult. I would say probably 5th grade at the most. If you were in person talking, and I was in the class with you physically, then I encourage students to sit in groups of 2 and 3 and work it together. No problem. Encourage them to work together, because one student may understand what is A or B column, and the other one says, no, I don't understand D and E. So one can learn from the other, and we can move much faster. Regrettably, because of this COVID business, we all sitting in our own little homes and apartments and cells and wherever we are, and not working together. So I assume, or you can go over to your friend's apartment and sit down with him and talk it over. I would encourage you to, if you like to, give you time to socialize also. He may treat you a Coca-Cola or a cup of coffee, and vice versa. He comes over, you treat him to coffee. But if you're a solo person and you don't like anybody else, just do it yourself. That's your choice. You will need a calculator. You can do it in your over here, multiplying, or you can use a simple calculator that has these functions of add and subtract and multiply. You would not even need to divide anything. How simple can you make it? I'll give you 15, 20 minutes. The screen will be just the way it is, nothing written here. Then I'll come back. You'll see me on the screen again. 25 minutes, give you plenty of time. You will have questions from attachment 1. That's most questions would not be very many because it's so simple. You say, well, maybe 1 or 2 questions which are normally asked, and I know generally what they are, and I've taught it for God knows how many years. So I'll answer those questions. Don't worry about it if you don't understand. You can always contact me if you still don't, but I guarantee you that would not be necessary. It has never happened. It's so straightforward. So once you have looked at this, cash basis, then I'll tell you the second kind of agreement is production sharing agreement, PSA. No, yeah, PSA, or also called PSC, production sharing, same thing. So I will show you, give you, it's an attachment, it's coming to you as an attachment with this today's lecture. It looks like this. All you see says attachment to production sharing contracts at the top. Similarly, give you 50-20 minutes to go through this cash flow, make sure you understand it, from A to L. Okay. I'll come back on the screen and see if I can answer your questions, because I would answer the question since I would know what they are, because I'll cover each column, A, B, C, D, E, F. Even if you don't have any question, I'll just tell you, A is the production, B is royalty, da, da, da. So I'll answer those. So you will have nothing to worry about. But I want you to go through the arithmetic yourself. How did we get to C? Why did we take D out of C? What is the point here? What is the net cash flow at the end? Multiply. You never know. It might be in the exam. I'm not saying it will be. It could be. Okay. So just don't say, well, yeah, I understand. But unless you do the arithmetic yourself, press the A multiplied by B yourself, you might be surprised when it shows up, if it shows up. So these two agreement types, concession and PSAs, we will, God willing, cover today. It should not be a problem. Okay? And if you do that successfully, no rushing, take it easy. I don't believe in rushing. And if time will allow, we will move into the third kind of an agreement. And that is called a joint venture. Joint venture. By way of, let me back up a little. Just one thing I thought, I might forget it, we might tell you now. Concession is the oldest kind of agreement. Okay. A PSA, production, was started in 1960, 60. That was the first time when the concept of PSA was launched. So it's been around what? 40 plus 20, 60, 61, 62 years. It was the first time it was started was in Indonesia. Okay, still prevalent. Concessions are still prevalent. The third kind of agreement, which we will talk about, is joint venture agreement, JOA. Joint operating agreement, joint ventures. We're going to talk about joint operating agreements and all that, but that's all part of the joint venture, the third kind. And in that case, there'll be a third handout. I don't know, maybe we call this as handouts or attachment. Don't be confused. If it says handout or attachment, it's the same. Okay, and this is, and you'll have this also attached with today's lecture. It says key provisions of joint operating agreement, joint ventures. What is a joint venture? What are the provisions in the joint venture? I am not certain whether we'll get to that today. We may start it today. If the time is not enough, we will just stop in the middle. And if I think, well, why do that? Why not just start joint ventures the next time in my next lecture? That we'll see how the time figures out, okay? After that, we'll come to the final and the fourth kind of agreement is service contract. Service is the name of a fourth kind of agreement. Concession, PSA, joint venture, service contract. Example, all contracts given out by the government of Iraq are service contracts. They're not concession, and they're not PSAs, service contract. So you can now already tell some countries like PSAs, others like service contracts, some do concessions. We do concessions in America, we do concession. We don't have a PSA. We have concession. Indonesia likes PSA. Why? That's up to them. We'll talk about it, the good and the bad, but then it's their decision, not my decision, what they want. My job is only and only to educate, not to decide for them. The benefits, the advantages, disadvantages. Having said that, there is no perfect agreement, if you ask me. None that I know of. I repeat, there is no perfect agreement. I have not come across one. However, there is one agreement type we'll talk about in part 3 of this course, which is my favorite, which is very close to being, not a perfect, close to being a perfect agreement. We'll talk about that also. For that, I'll take you to Colombia. So we're going to go to Colombia. From Indonesia, one end of the world, we're going to Colombia to look at another kind of agreement. That has nothing with concession or PSA. That's another aspect, another angle to agreements. So you can see it's going to be a very unusual, very interesting program today. And third part is even going to be more fun to teach and to listen, I hope. Take interest in what you're learning. No? Don't take it as, oh my goodness, we have to, no, you're very lucky you're getting the chance to learn. How many people would rather be listening in and sitting here and benefiting? Take advantage, please, of the opportunity. So let's get back to business now. As I promised to you, the only link between part 1 and part 2 is the word royalty. That's all. So therefore, I'll take a few minutes, very simple concept, and explain in my simple, easy way what is a royalty. Very simple. Give you an example, you'll understand it. Let us say you produce 100 barrels of oil, and it's $10 a barrel, so your total revenue, make sure you remember, your total revenue is what? $1,000. Write the word total, underline it. These are critical points here. Don't take it for granted. Oh, I know he said total. No. Write the word total and underline it. 100 barrel, $10 a barrel, total revenue is $1,000. And if the royalty to the government, royalties paid to the government or the landowner in America is 8%, so you take 8% of $1,000, which is the total revenue. Very important point, remember. You'll understand why I'm saying that later. That's $80. 8% is the royalty. $80 will immediately, off the top, these are important points, please remember, right away will go to the government of the United States if you're in America. That's it. That's it. I'll repeat so that maybe you're not quite getting the message. You will understand the message in a minute because it's so simple. 100 barrels of oil is produced by the company. Price of oil is $10. The total revenue, remember I kept saying it, is $1,000. The government says, give us a royalty of 8%, so you write them a check of $80. Case closed. The remaining amount of money is how much? $920. Remember, revenue minus royalty. The government of America says, no, that's your money. You can do whatever you want to do with that money. Very important, write it on. After taking out the royalty from the total revenue, whatever amount is left, the government says, the That's your money. You can bring Coca-Cola with it, or you can invest in more oil production and exploration. We don't care. You pay the chairman and whatever you want to pay him. We don't care. We got her $80. Listen to this twice when you're following this lecture. You say, well, it's so simple. I heard it, Dr. Malik. How many times are you going to tell me? I know. No. Remember, royalty goes to the government first. That's important. Right on. Royalty goes to the government first. What does first mean? After the government gets the $80, government gets the royalty first. Whatever is left can be spent whatever they want. So in the case of royalty, there's no risk to the government. Remember that. Because why are they not getting the royalty first? Now, let me explain again the same thing. I'll write it down. Now I'm going to get up and say, what is an aspect of royalty? First of all, now the lecture is about concessions. Based case of royalty, or government gets royalty first, very important. And government has what? Zero risk. And the reason I'm going to read this here, very important. It is possible. In my example, remember, of $80 going to the government right away, in an extreme case, you begin to understand why this is important. The company could be losing money while the government is still getting $80. They're making money and the company is losing money. This is the only kind of an agreement that if go in extreme case, the government still gets $80. And what happened? And the company could be losing money. I'll give you an example how that can happen. People don't understand what I'm saying till I show it to them around the world. $100 barrels of oil production, $10 per barrel, $10 per barrel price. All right, and the total revenue, very important. Is equal to $1,000. Okay. Royalty at 8% is equal to $80, correct? I hope you can read it. I want to check it dark enough because, yeah. So if you take royalty remaining cash flow, company is $1,000 minus $80 royalty is how much? $920. Okay. This is the money the company has. if, listen carefully, if the operating cost, the cost of doing the business, paying the salary, the drilling cost, and all of that, and the chairman's salary, the cars, and the jets, and everything, if the operating cost, let's write the word operating cost, that here is what? Let's put a number. Is $1,050. If the operating cost of the company is $150, so what has happened? That year, they have a net coming to them of $920. The operating cost of $1,050, the company has lost how much? $130. That is what? 1,050 minus to 920, that's minus, this is revenue, this is plus revenue, this is minus. So the loss to the company is how much in this year is $130 loss. Now 1,050 minus 920, $1,030. Let it go and let it sink in for a minute. No magic, so simple, simple. Again, while sitting here, I'll tell you, $100 times $10, the revenue is $1,000. Royalty is $80 after paying royalty to the government first. You left with $920. The cost of running the business is $1,050. So what? There's $130 is a loss. Why? Because the government got the money first and they had no risk. This is the only kind of an agreement, write down, where this can happen. And therefore, listen carefully. It's the only kind of agreement this can happen. No risk to the government. Every government in the developed countries, listen carefully. Every government in the developed countries, the ED, not developing, developed countries, America, Canada, Norway, big producers of oil, all over Europe, UK, every developed country, the type of agreements they have with oil companies is called a concession. Got it? You go to America, you go to Norway, you go to Britain, you go to Canada. Wow, they all have a concession. Look at that. That's the reason they have it. Let it go in now. Because the next statement is going to surprise you very much. I'm preparing you. Get ready. Where do we see PSA? Where do you see production sharing contract? Remember the second type, production sharing, Indonesian? We see PSAs only in developing countries, ING. Strange. Is it that American people and the Canadian people and the Norwegian folks are crazy? That they have concession, but people, I mean, in developing countries of Africa and Latin America are so smart, they're going the other way, and the Americans and the Canadians going this way. That's a wake-up call for those people who are doing PSAs. To think, why the Canadians and the Norwegians, Norway produces at one time they produced twice as much oil as Kuwait. Why are they going this way and people are going this way? Maybe the Americans and Canadians and the UK people are smart. They know what they're doing. Maybe, maybe not. So we will have to analyze that to the rest of today's lecture. Why are we going this way in developed countries? Why are they going the other way? Ask them. They're making a big mistake in the developing countries. Listen carefully now. And you say, hey, Dr. Malik, what do you think you are? I know what you're saying. Oh, who do you think you are? You're saying half the world in developing countries are foolish people, they're making a mistake. I don't know. I think so. Should you believe me? No. Because I'm saying so, is that right? No. I'm a professor, you should believe it? No, I hope you don't believe everything I say. Challenge me. Prove it. You just said, Dr. Malik, I hear you what you're saying. You're getting emotional about it. You're raising your hand and all low. So prove it. Stop raising your voice and shaking your hands. We want to see numbers. So that is the question. I'll show you the numbers to prove it. So now, I travel all over the world, developing countries and developed countries. Do I change my lecture for developing and developed? No. I'm far too honorable a person to change my lecture if I'm listening to developing countries. Oh, I should not say that. No, that is deceit. That is dishonesty. One thing I cannot tolerate is dishonesty. Why would I? And why should I? I have to let it down. I'm not paid by the oil company. I'm not paid by the government. I'm just a lowly professor. My credibility is online. Then when I explain to those people in the developing, what a mistake they're making, oh my goodness, I wish there was another Professor Malik who taught us, who told us what to do, because the contracts were written 20 years back, 10, 15 years back, and that guy, consultants, they don't know any better. What do the consultants know? The management consultant, some fancy business school. Where do they teach in management consulting? I don't know what is a management. I have no idea what is a management consultant. No idea. In fact, I'm going to come back and explain. I'm going to prove all this. If you ever look at my resume, CV, you'll see all kinds of, Dr. Malik has been a chairman of this, and has been a president of this, has been a senior advisor to this, all kinds. One word you'll never see in my resume is the word consultant. Never. You say, why are you so, I'm not against or in favor. I'm not a consultant. I'm what? Just a basic, modest, simple teacher, not a professor, teacher. What's the difference? You insult me if somebody says that. Say, hey, no, don't say. A consultant generally tells you what you want to hear because he wants the more business. Because if you say something different, you don't want to hear that, you don't bring him back. You just say, well, okay, tell us. And he figures what he may want. The client wants to hear this. So he says, hey, very good, come back. A teacher tells you what he thinks is right. Does not mean he's right. Remember, what he thinks is right. So whether I'm in developing countries or developed, my lecture remains the same. So now, I will show you the cash flow based on a concession kind of an agreement. Remember that. And then we'll allow you, I think maybe 25 minutes should be enough. take out your attachment based on attachment 1. By the way, I forgot, very important. I've not defined what is a concession. I kept talking about it. Simple. Any agreement type in which the government gets the revenue from a royalty, that, remember, here the government is getting revenue from what? Royalty of $80. That is called a concession. That agreement is called a concession type of agreement. Write it down. So when I say concession, that automatically means, that the government is getting the revenue through royalty primarily, mostly. Remember that. So these are two words, royalty, concession. Consider them as synonymous, identical, similar. Concession, royalty, royalty, concession, interchangeable. So we have royalty in America, so we have a concession type of agreement. So now you know what is a concession. One that is based on royalty, most of the revenue coming from royalty. No risk to the government because the royalties come, they get it first, okay? So remember that. And PSA, I'll define it differently, where the money is coming from PSA. First thing first, take out this attachment 1, it says concessions, and start from A, top, maybe if you do top 2 or 3, 4 lines, the rest is an Excel program. So you don't have to do the whole thing, just 2 or 3 top lines and see in multiply. A is the oil production, B is oil price, gross revenue. Remember, total revenue, gross revenue, the same word is C. Just multiply the price, A column by B, you'll see it. And if you don't, you can go to the bottom and you see the fancy formulas at the bottom. Now you're going to be on your own. Attachment 1, don't look at attachment 2 yet. 25 minutes, I think, should be enough. I'll see you then. In the meantime, some will work fast, some will work slow. If you work fast, when you finish, just sing a song or do whatever you want to do. But 25 minutes from now, be back here. I'm not going to ring a bell, I'm going to start. Then at that point, I'll explain every column, okay? And then I'll tell you what is a PSA, which will take a much shorter time. I've already laid down the ground rules. And then I'll show you the production sharing cash flow, which you can do much faster than the concession because now you already practice the concession. And then we'll talk about which is better, okay? And for whom. Then you decide for yourselves. Without this, these two cash flows, you cannot really fully appreciate what I'm telling you. 25 minutes. Now start the clock. Now I'm right on my watch. I'm to the second. I've marked it. I'll leave the screen there. Everything will be there. I'm not going to wipe out anything, so you can follow that from the screen. If you haven't taken notes, I shall meet you in 25 minutes. Okay? Very good. Take care. 25 minutes. Okay. I hope you're all back. I'm looking at my watch. Oh, wherever it is. And well, you got another 10 seconds to go. Oh, no, it's right on time. Please, the way we're going to do this is looking at attachment 1 only at this time. I'll go through each column slowly. There's not much to talk about. And generally, the impression you're getting probably is, from this impression, that when I put down on the board here, government gets the money first, and then there's no risk to the government because they get the money as royalty first, remember? And in an extreme case, in summary, I said, extreme case, the company would be losing money, in this case, $1,030, whereas the government is still making money. So it looks like, of course, it's a good idea for the government, no risk to them, and the developed countries of Norway and Canada, Britain, all have concession. That's the summary of what I said earlier. So obviously, leaving with you the impression that there must be good concession. Now, then I'll show you the PSA and I'll explain to what is that. And then we'll talk which is good or bad. Take out your attachment 1 or handout 1, whatever you want to call it. Let's look at the top, starting year 1995, 96, 97. You can see that is when I prepared this course, was 27 years ago. I've been teaching it. Same transparency doesn't change. Nothing has happened. So if you look at it, the column A, I'm going to do it slowly. And I'm looking at it myself right in front of me, is oil production from the field to the well, doesn't matter. B is, and everything, may I caution you, is a forecast. Everything is in the future. The year is 1995. What is the production 96, 97, and so on? So what will be the price in 96, 97, and so on? Is just a forecast. So the oil price forecast is seen in column B, straightforward. Gross revenue is total revenue, I kept saying. You look at the total revenue, remember I said it a dozen times. That's also called gross revenue. Is column A multiplied by column C. You can do it. You can do it in your head, or you can do it a simple calculator. And if you look at 1997, it'll come to $39,000. So now this is the revenue coming to the company. Agreed? And then, of course, the government is going to get the royalty first. In this case, we have come up with a royalty of 15% of the total revenue, of gross revenue. That means 15% of what? Of column C. If the math is correct, if the computer is correct, that's what the answer is. So after taking out the royalty and giving it to the government, the remaining royalty, you can call it net revenue, no, not remaining royalty, forgive me. The net revenue, the remaining revenue with the company is now in column E. It's just arithmetic, subtracting royalty from the gross revenue left with column E. And at the bottom, there's a simple formula if you can't follow the top. Of course, every company, if in any project, you have operating costs to run the company. It's also forecast. You can see the operating costs have been forecast, listed over here. Capital cost is, what's the difference? What's the operating cost? What's the capital cost? It's an accounting term. Capital cost is sometimes called an investment. That is the cost of, let us say, in this case, the cost of drilling the well. That's a capital cost. You make it up front, you drill the well, that's an investment. When the drilling people leave, they hand the key to the operating people to operate the well, get the oil out. So the capital cost is column G. That's the cost of drilling the well, spread over 2 years of $15,000 and $25,000, or 25 million or whatever. H column is depreciation. In this case, you can see H column is 8,000, 8,000, 8,000 spread over 5 years. So the capital cost has been spread over 5 years. That means over 5, you cannot take out the capital cost right away. The year you incur it. You spread it over a period of time. The government tells you, it's your choice, spread the capital cost. In this case, the government says over 5 years. So that means you spend $40,000 as capital cost. There'll be $8,000 a year for our spread over 5 years. That means that is called depreciation allowance. The $8,000 is called a depreciation allowance. That means is that you do not pay tax on $8,000. So you have to take it out of your having to pay tax. That money is still with you, but you don't pay any tax on it. Remember that on the depreciation. Later on, part 3, when there's a legislative question, policy questions, I will go into some detailed discussion of what is a depreciation allowance, why the government gives it around the world to companies to reduce the taxes. At this time, this might be enough. That means you do not pay tax on $8,000 every year, and you can see that also in the formula underneath here, the H formula. The detailed explanation will subsequently come. Normally, in the past, I would ask the students to take another course, PG 365, before you take this course, because in that course, I teach in detail what is depreciation allowance, not in this, but in that. But since you have not taken that course, or you may not, I don't know who's teaching it. I have no idea. I think maybe Dr. Bomer, I don't know. Maybe it doesn't cover depreciation costs there, or depreciation allowance. So I will do it at another time in part 3. It's part of part 3. But at this time, just assume that the 8,000 multiplied by 5 is a total of 40,000 will be taken out over 5 years on which you don't pay any tax. So you pay tax on the remaining. You take the total revenue minus the royalty, minus the operating cost, minus the depreciation loss, whatever is left, you pay tax on that. You meaning the company. That's why it says column I is taxable income. I just explained to you. Total income, total revenues minus all the 3 elements I gave you. And they are, of course, the depreciation allowance, the operating cost, and the royalty. And that is what you left with column I, tax. And then your tax rate is 30%. On that column I, you will pay a tax of 30%. So everybody's happy. You gave the government the royalty, you got your depreciation allowance covered here, then you got your labor costs, operating cost. Take all of these costs out of your total revenue, and you are left with what is column K. It is called net cash flow. Net cash flow. That is the money in your, you being the businessman, you being the oil guy, that is in your pocket. And I put an arrow, it's $140,000 over the life of the project. That ends in 2008. I cannot, even if I try very hard, make it simpler than that. So straightforward. You could, I'm sure some of you finished it in 3 minutes or 5 minutes. I allowed you 25 minutes. If you still have any questions, you can ask me. You can call me, or you can write to me, or do whatever you want. But if it is necessary, I don't know why would it be necessary. But I'm open. I'm more than willing to help. So in case of a concession, the company is now getting $140,000 at the end of the total. At the end, that's the cumulative total over a period of time. That's the cash flow as you have seen it, based on a concession kind of thing. You say, Dr. Malik, now let's talk about the other one called the production sharing agreement. Tell us something about that. We started, in Indonesia in 1960, PSA, and the developing countries doing it. Some are doing concession, but mostly they're developing countries that are doing PSA. Concessions only in developed countries, mostly in developed, or I would say only, but the developing countries are more prone towards PSA. Then later on, after you've seen what is a PSA or a PSC, then will be the appropriate time to take up, which is, you think, in your opinion, better from which angle, from the government angle or the company angle. Let me take this off. Give me a second at the back and start with explaining what is a PSA. It is very, very simple, not complicated, please. Now the explanation of a PSA or a PS. In a PSA, production sharing agreement, let us say the company has production, total production of $100 or $100 million. Doesn't matter. Let's start with 100. It's easy to follow. I could say $100 million. Okay, $100 is the total revenue coming from the company. Total. In this case, this is to remember, please. Extra attention to this point. In this case, from the $100, the government says to the company, remember, this case, PSA, take the cost of producing the oil. And the company says, okay, this year, it costs us $40 or $40 million to produce the, they call operating cost. This is called, they said, take it out. Don't pay us anything. You did recover it. First, take your money out first. In that case, the government gets the royalty first. Remember, this is the important, this is the crux of the whole discussion. Here, the government, remember, got the money first to royalty. Here, who gets the money first? The company gets to get the money first to recover the cost. So this money used to recover the cost is called cost oil. This is called cost oil. That's the name. After you take the cost oil of $40, how much is left? It's $60. 100 minus 40 is $60. This $60 is called profit oil. That's right, the word profit oil. First, the company takes the cost out, called cost oil. What is left is $60 called profit oil. this profit oil is split this might be a little wet, so I hope you can see it. If you can't, I'll read it to you. So this $60 that is left, or $60 million of the profit oil is split between the company, this is company, International Oil Company, IOC, under some ratio, which is negotiated maybe, and the government takes 70% of the profit oil. The company gets 30%. In this case only. So they split between the government and the company. 30% here. It could be 40% and 60%. It could be 80% or 20%. Then I'm not just an example. So after taking cost oil, what is left is called profit oil. The profit oil is split between the government and the company. That's all. That's all. That is called a production sharing agreement. Yeah, I think you can read it. A production sharing contract. Let us start to analyze it. And then you'll see a cash flow like you saw the cash flow for a concession. Remember that. Then we'll have a discussion which is good or bad for whom. Now, question, what is a PSA? A PSA is the type of agreement when you have what? The elements of cost oil and profit oil, that's all. If I say this agreement has cost oil and profit oil elements, immediately you'll say it is a PSA. These are two synonymous, identical. Profit oil, cost oil means PSA. Royalty-based agreement means a concession. So immediately. That's it. I say royalty is a concession. I say cost oil, profit is immediately PSA. Now, the fun is not just listening to me. The fun is doing it yourself, like before. And this should take less time because you already practiced with your calculator and concession. Now turn to attachment 2, which is in front of me also. And like before, I want you to move from column A all the way to column L. Same thing as before. Top 2, 3, 4 lines. Move from one to the other slowly. Multiply when necessary, add, subtract when necessary, and get to column L. Some people work fast, some work slow. If your finish is just wait because you're not alone, I'm waiting for others to catch up also, remember that. My responsibility is not to run with the front runner, but to have everybody, even the slowest student, on the train with me. I don't want to leave anything behind on the platform and the train is gone. That's not why I'm here. So take your time. And then after you've spent this time, I'm going to give you 20 minutes. Okay? But last time I gave you 25. So this should be faster because you know most of the things anyway. So let's save some time and get to the point. 20 minutes, please. Help yourself. I'll be showing up again in 20 minutes from now. Thank you. 20 minutes. The screen will stay that way and I'll be popping up in 20 minutes. I've loaded the time on my watch. Yeah, good. Then after that, the third kind of agreement, JO, Joint Operating Agreement, Joint Venture. I'm not sure if we will have the time for that today, but we will definitely next time. 20 minutes, I shall be here. Okay. Okay. Here we write on time. So let us begin now. After you've spent some time looking at a cash flow, at the same project, same oil price scenario, same operating costs, same tax structure, same depreciation allowance, same investment, same thing. The only difference between attachment 1 concession-based and attachment 2 BSA-based or BSC-based is the type of agreement, concession versus BSA. The rest is the same. It's the same project then. So we can move really quickly because most of the things we've already covered in attachment 1. This is PSA now. Turn to the PSA attachment 1. The column A, same. Oil production, B, oil price, same. Gross revenue, same as before. C, OPEX, same. D, CAPEX, same. 15 and 25,000. Depreciation allowance, split over 5 years or spread out over 5 years. Now, the difference begins. Remember, in this case, there is no royalty. The first thing we have to look at his new item is contractor cost oil. So the contractor gets to take out the cost oil of $11,900. That is made up of what? OPEX and the $8,000 depreciation allowance. And then whatever is left is called profit oil, as I've explained to you on the board, is $27,790. Simple and straightforward. Which then is split, the profit oil, between, in this case only, between the oil company and the government at a ratio of 35% will go off the profit oil to the company, off the profit, and the remaining 65% will go to the government. And on its share of the profit oil, in column K, the tax rate is 30%. The company will have to pay the corporate tax. And whatever is left is what is net cash flow to the company after taking on the OPEX and the CAPEX and all the rest, and then paying the income tax or the corporate tax in this case. And the amount that is left is in column L. Simple as that. And you can see at the bottom, this is where the discussion will begin now, that in this case, at the bottom, which is yellow and arrow, last line at the bottom, the company gets $62,000 in case of PSA. You get it? You see it. Whereas I'm going to switch back to attachment 1. Now you should be seeing attachment 1 based on a concession. The company is getting $140,000. You can see the arrow. Concession, company gets $140,000. PSA, the company gets $62,000. Obviously, you're going to say, hey, Dr. Malik, we have caught you. We've caught you, Dr. Malik. You've been all along telling us and giving the impression that a concession is good for the government and bad for the company. But in this case, we see the difference. Company gets $140,000. In case of a concession, in case of PS, the company gets only $62,000. So just the opposite what you've been preaching to us for 2 hours. That's the mistake that people make. I got you, no. Now listen to this very, very carefully. It's very simple. Both the cash flow, the $62,000 case of a PSA, and the $140,000 in case of a concession. Both of these amounts at the bottom that you see can be made exactly the equal. Exactly the same, both of them. 140 can be made equal to 62, or 62 can be made equal to 140. Very simple. I don't know the ABC, not the first thing about programming. Even I can make a program. Even I can make a program which who has no idea how to program computers, that I can make the two cash flows the same by simply, give you an example, attachment 1, royalties 15%. And the company gets $140,000. If I double the royalty to 30%, the company will maybe get about half of that. It's about $70,000 because the royalty goes to the government. And if I play a little bit, I can make the royalty higher a little bit and make the $140,000, but just by playing with the royalty alone, exactly the same as $62,000 of the PSA cash flow. I hope it's simple. Both cash flow can be made the same at the end of the project life and paying all the expenses. Then you say, well, what's the problem, Dr. Malik? Well, if both are the same, then where is the problem? The problem lies not in who is making more money under PSA or concession. The problem lies only and only on risk-taking. In the case of a concession, the government does not take any risk, zero, because they get the money first. You've seen it, I've written it still on the board. In a PSA, no. The government taking a risk. What if the company inflates their cost and pays everybody a very high salary and recovers it as cost oil? There's no money left for the government in the case of profit oil that is left. They've got hardly no money left for the government to get because the company took everything as a cost oil. So the government is taking a risk in the case of a PSA because there could be a temptation. I'm not saying the companies are going to do it, but there could be a temptation for them to inflate the cost oil by paying everybody a hefty salary, as an example, extreme case. So there lies the difference, not in the amount of money under PSA. This is what governments don't realize. Oh, maybe we make no, you don't make more or less money in either one. You can make the same amount. It's just that in case of in the government of America, that's what it is. This is what you give us the royalty, folks. We do not care. At the end, what you do. Pay the company as CEO $1 million, you pay him $30,000. Doesn't matter. We got the money. In case of cost oil, you can't. You got to keep on looking at the company cost structure. And there lies another problem. And I said, the first thing that you need in any relationship is trust. In concession, there's no reason not to trust the other guy. They give the money, I don't trust. You do what you want. In a PSA, if you start looking at the company's cash flow and say, why are you paying this guy so much? Every time you say, why are you doing this or that? There's lack of trust on the part of the government, not trusting the government. So that's why I preach more in favor. No, this is up to the government what they want to do. It's not my problem. My problem is to educate. So now you've got two kinds of agreements under your belt, concession and a PSA. Now I have to think carefully whether I should proceed with the third kind called the joint venture. And what is a joint venture? And how are they governed? How do they work together in a joint venture called the joint operating agreement? I think it's a little late in the day and very little time is left. The best thing is to start with the joint venture and JOA, joint operating agreement, the next time. And we'll start with this. This is the third attachment that you have. So the next time when you meet me, please make sure you have the joint venture agreement, JOA, in front of you, which is attached with this lecture, today's lecture. So don't throw this today's lecture because you're going to be needing it next lecture. It'll be part of the next lecture, okay? Having said that, have a good day. Take care of yourself. Stay away from COVID. I think we only have one lecture before you hit the spring break and spend your time on the beach or wherever you're going. Good luck and best wishes.